They are saying the inflation drop is fake. So the March 2025 inflation data from US Statistical Agency shows a notable decline, but underlying pressures and policy risks suggest caution in interpreting, this improvement. So here are the headline improvements. So you have the annual CPI inflation rate that fell to 2.4% in March, down from 2.8% in February, marking the lowest level since 2021. The core inflation, excluding food and energy, eased to 2.8% annually, the slowest pace in 4 years. Transportation costs dropped 0.9% year over year, driven by a 14.4% plunge in gasoline prices and declines in airfare. Shelter inflation cooled to 4% annually, its lowest since November 2021. Now, there are persistent pressure points. You have food prices rose 0.5% monthly for groceries, right, exceeding the Fed's target pace. Egg prices surged 60% annually due to avian flu shortages. Motor vehicle insurance spiked 7.5% year over year, contributing 8.9% to overall inflation. Dining out costs increased 0.5% in March, reflecting rising ingredient and labor expenses. Now, here are the looming risks, right? Economists warn Trump's aggressive tariff policies, the most significant in over a century, could reverse, disinflationary trends by raising import costs. Now, while seasonal energy price declines and housing market adjustments currently suppress inflation, tariffs may reignite price pressures in coming months. The Federal Reserve remains cautious as core services, like inflation remains elevated despite recent improvements. So the factors that are contributing to the drop in inflation, you have the energy prices, right? A significant decline in gasoline prices has contributed to lower transportation costs, which play a major role in reducing overall inflation rate. Housing costs is another factor. So moderation in shelter costs, including rent and housing prices, has helped ease inflationary pressures. This sector had previously been a major driver of high inflation. There's the removal of temporary inflationary pressures, so the fading impact of pandemic-related supply chain disruptions and fiscal stimulus has reduced inflationary pressures. As supply chains stabilize and demand normalizes, price increases have slowed. Central bank policies also play a factor. The tight monetary policies, such as higher interest rates implemented by the Federal Reserve, have curbed consumer spending and borrowing, contributing to disinflation. We are tech people here. Technological advancements also, right? Improvements in technology have increased labor productivity and reduced unit labor costs, which can suppress inflation by lowering production expenses. Now, here are the predictions, right? The potential predictions for inflation in regards to the second half of this year. So we have the base case projection. So the headline is CPI expected to average 2.8% year over year in Q4 2025, revised up from earlier estimates of 2.5% due to sticky core components and tariff impacts. You have core CPI, the forecast at 2.9% Q4, right? Driven by persistent services, inflation, and lagging shelter costs. The core PCE, analysts project 2.7 to 3% annualized, with elevated probabilities of readings above 2.5% through year end. Now, here are the key upside risks, right? Tariff pressures. The implemented 10% tariff on Chinese imports has already added 0.1, percentage points to CPI forecast. The proposed additional tariffs, not yet enacted, could reignite goods inflation, particularly for electronics and machinery. Consumer expectations, so rising inflation expectations, right? Like the University of Michigan's forward outlook jumping to 4.3% may embed higher wage/price dynamics. Labor market resilience, so strong payroll growth, 145,000 per month forecast, and 4.2% unemployment rate could sustain demand side pressures. The downside moderators are the monetary policy. So the Federal Reserve is expected to delay rate cuts until at least September, maintaining restrictive financial conditions. Energy trends, seasonal declines in gasoline prices, if sustained, may offset some tariff-driven goods inflation, right? The scenario analysis, optimistic, right? If tariffs remain limited and labor costs cool, core PCE could dip toward 2.5% by December. Pessimistic, escalating trade restrictions and unanchored expectations might push core CPI above 3% through 2026. Now, gasoline prices are influencing the overall inflation rate. So, direct impact on headline inflation, you have the CPI weighting. Gasoline accounts for 3.6% of the consumer price index, making it a key contributor to headline inflation. We have recent trends. So gasoline prices fell 3.1% year over year in February 2025, helping moderate overall inflation. However, earlier volatility saw prices surge 89.5% from January 2020 to June 2022, driving CPI to 9.1% in mid 2022. Now, the indirect effects, you have transportation costs, right? Higher fuel prices raise shipping and logistics expenses, which ripple through goods prices. Now, plastics and petrochemicals, oil is a key input for plastics, affecting prices of consumer goods ranging from packaging to electronics. Now, inflation expectations, so gasoline's visibility amplifies its psychological impact. In high inflation periods, consumers revise expectations more sharply in response to fuel price changes, potentially embedding wage price spirals. Now, there are structural shifts as well, right? Reduced oil dependency, like the U.S. economic reliance on oil, has halved since the 1970s from 1 barrel per 1,000 GDP to 0.4 barrels, right? Dampening inflationary pressure from energy shocks. There are policy risks, right? Proposed tariffs and renewable energy transitions may reintroduce cost pressures, partially reversing recent disinflationary trends. So that's what I have here today. Please take a moment right now to hit that subscribe button and the like button. If you gained value from this video and you want more videos like this, let me know by hitting that subscribe button and the like button. See you in the next video.